This week, the CFPB highlights loan officer compensation rules and reverse mortgage lender compliance.
Building relationships is the way Mutual of Omaha has grown into one of the leading financial services companies in the world. Our reverse mortgage wholesale division is proud to carry on this 100-plus year tradition. To your borrowers, a reverse mortgage is more than a transaction. It's a promise of a better, more stress-free life. Our goal is to provide you, our valued client, with the best service and support possible so you can focus on helping your borrowers achieve the retirement of their dreams.
Welcome back to the Industry Leader Update. The CFPB is closely examining loan officer compensation, an agency priority which is addressed in the Bureau's supervisory highlights. Loan officer compensation rules fall under the Truth in Lending Act, which was passed in 2013. This rule was enacted as a way to reduce product steering and to prevent originators from charging differing fees or interest rates based on any term or condition of the loan being offered. Put simply, a mortgage originator cannot be paid more or less than a typical loan file based on the product type, fixed arm, bond, etc., the interest rate or APR, loan origination fee, the type of collateral, or the existence of a prepayment penalty. Now, for reverse mortgage professionals, typical variations of a HECM include a fixed rate, annual adjustable, or monthly adjustable. And each has its own unique fit based on the needs of the homeowner and the ideal structuring of the loan. Under the current regime of Reg Z or Regulation Z, LO compensation is somewhat of a sticky wicket. Regulation Z generally prohibits compensating mortgage loan originators in an amount that is based on the terms of the transaction, says the CFPB in its report. It defines a term of a transaction as, quote, any right or obligation of the parties to a credit transaction. And it provides that a determination of whether compensation is being based on a term of a transaction is made based on objective facts and circumstances, indicating compensation would have been different if a transaction term had been different. Now, of course, there's going to be some subjective judgment here, and like many government regulations, the restrictions on loan officer compensation have unintended consequences. In late 2018, over 200 mortgage lending executives appealed to the CFPB to loosen LO compensation restrictions and allow originators to reduce their compensation in order to remain competitive. Then in February 2020, Housing Wire reported that borrowers might have to switch lenders in the middle of a transaction or the loan process if the lender decided the loan wasn't profitable enough. Now, the rule prohibits MLOs from taking a cut of their comp, which is also meaning that the loan could end up being more expensive for the consumer. Now, such concerns have not gone unnoticed, and Reverse Mortgage Daily reports that the Community Home Lenders of America, CHLA, supports changes to the LO comp rule. In May, the organization drafted a letter to Director Rohit Chopra, and it says that the current rule's inflexibility in certain areas is a detriment for consumers. Now, further clarification of the LO comp rule was noted in the 2013 final rule to state that it is, quote, not permissible to differentiate compensation based on credit product type, since products are simply a bundle of particular terms. You know, the CFPB did examine reverse mortgage compensation since there are typically different loan types, but here's what the Bureau noted in their report. For example, the institutions used outside lenders for reverse mortgage originations, but had their own in-house cash-out refinance mortgage product. Bureau examiners determined that the institutions used a compensation plan that allowed a loan originator who originated both brokered out and in-house loans to receive a different level of compensation for the brokered out loans versus those that were done in-house. This, says the Bureau, constituted a violation of Reg Z. Now, the road where regulation, reasonable profitability, and compliance costs meet, it's a rocky one. And with lender costs increasing and profits becoming more difficult to come by, now is the time to revisit the LO compensation rule to ensure consumer protection and also the continued availability of the loan to older homeowners. Now, what are your thoughts on LO compensation rules and how they apply to reverse mortgage loans for brokers especially? Leave your comments in the comment section below. Please be so kind as to share this week's video on your LinkedIn profile. And don't forget, we have a YouTube channel where you can subscribe and hit the notification bell. And each and every week, we bring you your reverse mortgage news in both an audio and video format, HECM World Weekly. You can find us on Apple Music. We're also now on Spotify and, of course, on YouTube. That's a wrap for us. Have a great week, and be sure to return next Monday for more reverse mortgage news, commentary, and analysis here at HECM World.